The US jobs data has upped chances of one more rate hike from the Fed, probably in July, although the June futures pricing remains unchanged. It's a pause. Why is it so important for India? Well, one, tighter global financial conditions in the US means tighter conditions for all economies. Second, a huge part of the upside surprise in India's fourth quarter GDP came from net exports, and hence a global slowdown can dull that part of our growth story. And third, another rate hike from the Fed means an RBI rate cut also gets pushed out further. For more on the India growth and inflation story, I have with me Santanu Sengupta, the India economist at Goldman Sachs. He is also the man who has upped India's GDP forecast twice in the last 10 days. Santanu, good morning and thank you very much for joining us. Well, you upped the India GDP forecast earlier, I think May 26th, if I'm not mistaken, from 6 to 6.3, and then it was a further 10 basis, 6.4 after the Q4 GDP numbers. What went into this two sets of upgrades?
Sure, thanks, Lata. So the first one was due to the net export boost that we were anticipating. Coming in from stronger services exports, lower imports, and hence an upgrade to the calendar year 23 growth forecast from 6% to 6.3%. Thereafter, once the Q1 calendar year 23 or Q4 FY23 data came in, we saw that investments had surprised higher than what our expectations were. We actually have cut the sequential path for investments going forward because we've seen a very strong boost in Q1. But the net impact of all of this is that the annual number, calendar year 23 gets revised up by 10 basis points.
Okay, and that's why, I wanted that because, therefore, how serious is the jobs data? If there is another rate hike from the US, do you all foresee a greater global slowdown? What is your US economist telling you post the jobs data in terms of rate hikes and in terms of a possible deceleration later on?
In fact, the jobs data has been stronger than our expectation and market expectations.
Yes.
It's exceeded consensus now for the 14th straight month. Remember, we have been above consensus forecasts pretty much for the whole of the year. So our US GDP growth forecast is 1.7% year over year. Consensus is around 1%, which is caught up from mid-single digit earlier in the year.
Okay.
We think that the recession probabilities in the year are much lower. We have forecasted 35% recession probability in the US 12 months forward versus the market expectation at about 65%. So that's almost half of the recession probability. Our view still is we continue to expect a pause at the June FOMC meeting, reflecting the mixed household survey, the softness in the hours worked, and a decline in the average hourly earnings growth. But overall, from a labor market point of view, data is actually looking better than what expectations were.
Okay, no, my point is that if there indeed is another rate hike, then are there just that downside risks to second half or FY24 growth globally?
So growth, again, as I said, our view is that the US growth has been surprising above expectations, and
yes,
we have
absolutely.
held on to that 1.5% kind of view. So the recession probability, which is where you get into the deep growth slump, is lower in our view, especially with the strong data that is coming through. So even if the Fed was to hike one more, it is more through financial conditions that we would see the impact. But having said that, external balances are looking much, much better for India. We have highlighted, and we have been highlighting that INR stands out as one of the best carry-to-volatility currencies, carry-to-vol currencies in the EM complex. And hence, from the financial market risk point of view, we think that we are adequately prepared even with the higher FX reserves.
Okay. The point is that there is an outsized contribution from net exports. As you say, 30 basis point you had to increase. Even the Reserve Bank's forecast for the fourth quarter, I think in April, was like 4.3 or 4.6 or something like that. I mean, nobody guessed this fourth quarter jump. Primarily, it appears because nobody expected the global growth to be so strong, and that was impacting India as well in the form of net exports. Will that continue to play like that, Shantanu?
So on the net exports front, the first point was that current account forecast got revised, including us.
Yes.
We think current account deficit is now at 1.4% of GDP, but that's again being driven by very strong services export growth. We have shown in our earlier research that even as the large 5 IT companies in terms of dollar revenue growth is slowing down, in terms of revenue growth year over year over the last 5 or 6 quarters, India's aggregate software services exports growth has held constant around that 20% year-over-year growth range. That tells us that our growth from software services now is much more broad-based, and hence you should be able to see through this cycle. The second part was the lower imports growth, partly a function of commodity prices being lower. So while the net export boost will reduce in the next 4 quarters compared to what you've seen in the Q1 of this year, calendar year, we still think that on aggregate, it will be a net export boost than a net export drag for GDP growth for either calendar year 23 or fiscal year 24.
Okay, and so now we can come to the MPC. Our Citizens MPC, which we hold, has voted 5-0 for a pause. What's your expectation on, I guess pause is everyone's expectation, but what's the expectation on the stands as well?
Yeah, so our expectation is that of a pause. I think on the inflation front, the Q1 of F24, which is the current quarter, we are about 50 basis points lower than what the RBI has projected in its most recent forecasts. We think that the RBI will be revising down the Q1 F24 forecast as well. For the aggregate year, also, we are about 20 basis points lower than where the RBI is. Now, with the stance, our view is that they continue to retain the stance of removal of accommodation. And there are a couple of reasons for it. One, financial conditions have eased since the last policy meeting. So whether you look at short rates or long rates, 10-year equities, they are higher. So overall financial conditions have eased. To the liquidity situation, the banking system liquidity in the domestic market has completely changed over the last 2 weeks or so. First with the repo auction of 50,000 crore, then with the withdrawal of the 2,000 rupee notes and hence deposits back into the system. And 3, also our macro view, which I talked about a bit earlier on the current account, which in our view, even with conservative flow assumptions, keeps the balance of payments flat, which means that every time you have excess flows, the RBI can lean against them and keep acquiring spot reserves without sterilizing and injecting liquidity. So all of this tells us that given the liquidity situation quite benign now versus about 2 weeks back, they will have to be in a withdrawal mode in terms of the stance, and hence removal of accommodation continues in our view. Okay.
Now, what's the expectation of a cut? What's your inflation forecast? You said that you are expecting RBI itself to lower. RBI stands at 5.2 on inflation and 6.5 on growth. What do you expect RBI to do, and what's your own forecast?
Yes, the first thing is that RBI's inflation forecast for the current quarter, our estimates are about 50 basis points lower than where the RBI is. So our expectation would be that the RBI will be revising out the current quarter numbers. In terms of the subsequent quarters, we are more or less in line with the RBI, but the net result, again, is about 20 basis points lower on the aggregate annual basis in terms of inflation. Our expectation of a cut is we don't have any cuts priced into this calendar year. We only have something penciled in for Q1 of calendar year 24 or Q4 of fiscal year 24. But one thing to keep in mind is that in any case, this cutting cycle, in our view, is going to be shallow. You only went up to 6.5% in terms of the repo. Your core inflation is still relatively sticky in terms of services inflation. We still have to see services inflation come down at a time when growth continues to be relatively strong. Core goods inflation will come off. That's been our view as well. But even then, it's slightly surprised above where our expectations were. So we need to see a decisive slowdown in core inflation, and then headline coming towards the 4 to 5% region for the RBI to feel more comfortable and have a deeper rate easing cycle. Otherwise, this cycle, in our view, is going to be relatively shallow.
Which is two cuts?
I would say somewhere in the region of 575 to 6 is where you will settle at for the repo, given where your inflation dynamics are.
Okay. And your own RBI is at 5.2 in terms of inflation this year. Where are you, and do you expect RBI to lower?
We have a 5% on inflation for this year. But again, that is mainly being driven by this quarter being lower. So our expectation would be that once the monetary policy statement comes out, you will have an inflation forecast for the current quarter, which is lower than what the RBI has.
Which will be 4.6 or something. That's true.
That's right.
Yeah, so that would bring the overall RBI forecast lower as well, perhaps closer to yours. Okay, Shantanu, we look forward to the RBI policy and a meeting with you thereafter for your comments. Thank you very much for joining us today with your thoughts. So I think the big takeaway is that the jobs data is indicating that things will not decelerate much even in the future in the US, and that adds actually as a tailwind to India's growth story, which is doing very well because of net exports. We wrap up on Bazaar on that note. Chartbusters up next.